Edward Najarian is the head of bank research at ISI Group. He says the fourth quarter will be weaker for banks from a revenue standpoint, and he's joining us from Richmond, Virginia, with more. So let's start with Citigroup, Ed. Citi coming out today with this loss. The shares are trading higher. People seem pleased by the trend in credit losses. Credit losses shrinking somewhat. Do you think that's a trend that's going to be able to continue?
Yeah, I think we're seeing stability in credit metrics, especially for the big banks, a little bit earlier than we anticipated. We saw that at JP Morgan broadly. A few things went up, a few things went down, but across metrics broadly, we saw some stability. And we saw the same thing at Citi. Delinquencies pretty flat, non-performing assets flat, and credit losses themselves actually declined. So that was the good news in the quarter.
What do you think is driving that when you still have the unemployment rate holding steady? You still have at least some economic metrics that remain weak. How are these credit numbers able to look better?
Yeah, well, first and foremost, they're not looking extraordinarily better. They're looking, I would say, stable to slightly better relative to the third quarter, which was not that great. So that's the first thing to take note of. They're still very elevated. But secondarily, I think we're seeing really some of the effects of the fact that unemployment is leveling off, that we have seen better stability in home prices over the last 6 months. And I think probably one of the biggest underlying metrics is that new jobless claims actually peaked way back in the spring. And so we're getting to a post 180 days beyond that point, which means that that might have been the peak in early stage defaults. And now, as those cycle through the credit cycle and finally get to a loss, we're starting to see that benefit of a peak way back in the spring in those new jobless claims.
Well, Ed, speaking of Citi today, the operating expenses were higher than expected, but the stock still not making a profit as far as an operating basis is concerned.
Yeah, I would say that's a problem for Citi, and that's certainly something to take note of. The fact that their loan loss provision and their credit losses were both below analyst expectations, yet still in the red, even on an operating basis, even when you take out the large DVA loss or CVA loss that they had, as well as the very large TARP repayment fee, still a few cents below break even. And so the real story there is revenue weakness. This is a company that's been shrinking its balance sheet. We saw some fairly disappointing trends on the revenue side, especially regarding net interest income, their spread-based piece of revenue. And while they've been working hard to shrink costs, we did not see operating costs come down from the third quarter, and they're just not quite coming down fast enough relative to core revenue.
You know, we've been talking about the CEO of Citigroup for a long time, Vikram Pandit, and how he's doing in shareholder dissatisfaction. Prince Al-Walid bin Talal, one of the big shareholders, had been supporting Pandit for a long time. Finally, he's changed his mind and said Pandit really needs to deliver. What's your take on this? Is he going to last as CEO of Citigroup?
I do actually think he's going to last. We would say that the company is going to move to modest profitability in 2010, and then things are going to improve from there. So we know from the Bank of America experience there's not a lot of ready-to-go, experienced people to run that size financial institution. And I would say yes, but it's important to remember that to survive, Citi had to dilute shares outstanding by approximately 5 to 1. There's now 28.5 billion shares outstanding. So even when earnings recover, the path is really to get back to normalized earnings, maybe by 2012 or 2013 of about 50 cents a share. But with that much dilution, it's hard to see how it goes much higher than that. Ed,
I want to switch gears a little bit and talk about Bank of America, which we are going to hear from tomorrow. Credit loss-wise, do you think we'll see a similar trend there, improvement on that front?
Yeah, I don't know that we'll see improvement, but I do think that we'll see somewhat better credit metrics than probably analysts were anticipating. I think broadly, analysts do not have real high expectations for the credit quality performance of B of A in the fourth quarter. In fact, we all expect it to get a little worse. Judging from the JP Morgan and the Citigroup results, maybe we'll be modestly pleasantly surprised, but I don't know if we'll be as pleasantly surprised as we were at Citi. On the other hand, B of A is probably going to disappoint expectations a little bit on the revenue side. We're seeing weak fixed income trading. We're likely to see that at B of A.
Right.
Weak retail brokerage revenue, and again, weak net interest income.
And Ed, we have about 25 seconds left. The banking sector as a whole for 2010, what are your projections?
Well, you know, we certainly think profits will do better in 2010 than they did in 2009 for most of the banks. Importantly, though, that's not really being driven by revenue improvement. In fact, our revenue numbers broadly for the industry are down this year versus last year. But the improvement in credit, and not so much the credit loss themselves, but the decline in loan loss provisions is probably going to more than overwhelm that and give us some lift in earnings.